Hello, everybody. Wanted to welcome you to today's business support series with the Chamber of Commerce. We have Ian Galloway, the regional executive of Portland branch of the Federal Reserve, here to talk to us about federal policy and what that looks like. He is going to he's actually, gosh, I did a little bio with him. He's been with the Federal Reserve for 16 years and in his current position for 2. So I don't want to steal his thunder, so I will welcome him. And again, we don't have very many on the call today, so feel free to ask questions. Ian is here for us to answer any question we have, and he'll do the best he can. So Ian, take it away.
Absolutely. Thanks, Rhonda. I really appreciate it. Thanks, everybody, for joining today. Looking forward to the conversation. Please interrupt me at any time if you have any questions or comments. I hope this is as much of a dialogue as it is me sharing some information about the Federal Reserve and our current thinking as it relates to monetary policy. So as Rhonda mentioned, I am the regional executive of the Portland branch of the Federal Reserve Bank of San Francisco. I know it's a mouthful. But most of my job is to engage with the business community in Oregon, the Panhandle of Idaho, and a little bit of Southern Washington, with the express purpose of gathering essentially qualitative economic information about what's happening in our region and sharing that with our president and our economists so that they can better understand the current state of economic circumstances here in the state and how that may or may not impact our thinking as it relates to monetary policy and setting interest rates. So really happy to be here today. Hopefully we have time at the end where we can talk a little bit about what you're seeing on the ground in your respective businesses and regions. That's really helpful information to us, particularly during periods of economic uncertainty, where the data, which we have quite a bit of and analyze quite thoroughly, but the data tends to be a bit backward looking and won't necessarily tell us what's happening next. So these conversations are really essential for our understanding that context and helping us forecast what we can expect when it comes to the economy and how our monetary policy is making its way through various sectors across the country. So that's a long introduction. Let me just go ahead and dive in. And then again, please interrupt at any point if you have any questions. I'll do my best to answer the questions that you have. If I can't answer your question, I'm going to write it down, take it back to the powers that be at the Fed, and get you an answer. So I apologize in advance if I have to punt on certain topics, but I will make sure that you get appropriate answers from the appropriate folks after this session. So let's go ahead and dive in. Can everybody see the slides okay? Okay. If that doesn't work, just holler at me and I will reset it. So let me start kind of high level. The Federal Reserve, of course, is the central bank here in the United States. It's unique in the world in the sense that it's a bit of a decentralized central bank. We have a board of governors in Washington, D.C. Those folks are nominated by the president, confirmed by the Senate, and are basically Federal Reserve employees and work as part of the federal government. The rest of the Federal Reserve System is a collection of Federal Reserve regional banks. So we have 12 regional banks. I work for one of them, the San Francisco Fed, but you likely have heard of the New York Fed, the Boston Fed, Dallas, Atlanta, Chicago, Richmond. So a number of different Feds scattered across the country, representing very different regions of economic activity. And the sum total of those 12 regional banks and the Board of Governors is what we refer to as the Federal Reserve System. All right, so what do? We do a lot. This is a sort of truncated list of the functions that we perform at the Fed. But sort of the high-level activities are, first and foremost, we, of course, formulate monetary policy, so setting interest rates. We supervise and regulate financial institutions, not all of them. Our counterparts at the FDIC and OCC and the state banking regulators also regulate banks. So we regulate Federal Reserve member banks as well as bank holding companies. So just a smaller slice of the overall banking community. We foster payments and settlements safely and efficiently, and we maintain sufficient supplies of currency and coin to meet public demand. So we don't actually print the currency or mint the coins, but we order it when supplies of currency and coin dwindle or need to be replaced because the currency's been damaged and or otherwise needs to be taken out of circulation. All right. So how do we know we're achieving our goals? Well, first and foremost, everybody who wants a job can get a job. So that's the employment side of our mandate. Second, the dollar in your pocket has consistent value, of course. That's the inflation side of our mandate. The financial and payment system works day to day. And you can get cash and coin whenever you need it. So that's sort of the high level functions and the goals that we have as an institution and as a Federal Reserve System. So I was going to spend a little bit of time on monetary policy today in particular. So obviously monetary policy has been in the news quite a bit as inflation has been elevated over the course of the last year and a half or so. So I thought it would be helpful, hopefully, to do kind of a quick refresher on what we do here at the Fed and how that translates into monetary policy and the things that drive our decision making. So I'd like to start, if that's all right, with our dual mandate. So the Fed has essentially two monetary policy mandates. They are in balance, but occasionally in tension. So the first is maximum employment. So the goal here is that, again, everybody who wants a job is able to get a job. And the second is price stability. So this is keeping inflation low, making sure that the dollar maintains its value and isn't eroded by inflation. When you think about monetary policy and the mechanism of interest rates, essentially, as interest rates go up, it becomes obviously more expensive to borrow money. That slows business activity, household spending, borrowing in general, which tends to cool the economy, which brings supply and demand back into balance, which can hopefully lead to lower inflation, disinflation. As that happens, of course, and the economy cools, that can have an impact on demand for labor. So as we kind of pull down inflation, unemployment could go up as a result. Keeping these two things in balance, again, is what we call our dual mandate. So we're constantly thinking about these two North Stars and doing everything we can to make sure that they stay as much as possible in balance. So I want to start with our employment side of the mandate. As you can see here from this chart, there was a pretty significant increase in unemployment as COVID hit. I think it peaked sometime, I can't really see here in the chart, but I think sometime around April of 2020. And I think at that time, there were roughly 20 million people who were out of work as a result of the pandemic. The good news, of course, is that that snapped back pretty quickly over the course of the next 2 years, as you can see in the chart. And we've now dropped down to what we consider to be roughly the long-term trend rate of unemployment. In fact, a little bit below that. But as you can see from the dotted lines, we are forecasting, given the rate environment that we're in, that there may be some softening of the labor market going forward, which is reflected in a slightly higher unemployment rate over the course of the next couple of years. So I want to dig into this a little bit further. We don't, of course, just look at the unemployment rate when thinking about the employment side of our mandate. So this is a chart tracking job creation over the course of the last 2.5 years. As you can see, there were significant increases in new jobs between 2021 and 2022. But ever since then, there's been sort of a steady decrease in the number of new jobs created on a monthly basis. So you can see that from the 6-month moving average blue line. So the way that I interpret this, and I should have started this whole presentation with this disclaimer, and I apologize, but I'll do it now. I am not an economist, nor am I a monetary policymaker. My job is really to make sure that the voices of Oregon businesses are heard by our monetary policymakers and our economists. So I am presenting these slides and this information as sort of somebody who is not an expert in the underlying economic conditions. And again, happy to take any questions about this data back to the real economists who I'm sure can get you a much better answer than the one I can provide to you at the moment. But I can share these with you, and we can talk about what we think it means for the state of Oregon and your business and the sector that you're in. So all that being said, this is job gains over the course of the last 2.5 years. You can see that steady decrease. So that's indicating to us, of course, that there is some underlying softening of the labor market, which is, again, sort of an indication that the economy is probably slowing a little bit, and firms are not quite as anxious to hire folks as they were a couple of years ago. The other slide I wanted to share with you as it relates to the employment side of the mandate is the number of hours that employees are working. You can see from this chart that the number of weekly hours sort of bumps along a little bit between 34.4 and 34.6 for the few years leading up to the pandemic, and then spikes pretty significantly at the end of 2020, beginning of 2021. I think the way to interpret this, and again, I am not an economist, but the way that I would interpret this based on what I've heard from businesses who were hiring during this period, is that people were really hard to find at this time. And, you know, a lot of folks were staying home because of the pandemic, or they were caring for a loved one, or otherwise couldn't fully participate in the labor market. And so the folks that were still in the labor market were being asked or given the opportunity to work additional hours, which they did. And that's why you see this spike in the number of hours on a weekly basis that employees were logging. Now, as the labor market again has softened over the course of the last year or so, you see this demand for higher weekly hours begin to come down, approaching roughly what we saw before the pandemic. So just another data point indicating to us that the labor market continues to soften, even if the unemployment rate remains at below trend.
Just a comment here on those last two slides. So what I wonder is how much of that is being driven by the business and their demand for employees and their demand for hours, and how much of it is being driven by having to shift how you do business to accommodate your employees. So if you're a business and you'd really like to add 10 jobs, and you know that there's not 10 employees available, do you just shift your focus and say, well, we're only going to add 5 and reshift? You know, I don't know. It's interesting to me if it's being driven by the employer's need or the employee need.
That's a great question, and not something I can answer from this slide alone. And I guess the way I would approach it is it takes 2 to tango, right? And you know, this is showing ultimately the number of hours worked. The underlying reasons for that are hard to discern, but I think your instinct is right that it probably was a bit of a negotiation between employers and employees, and employers probably had to make some concessions as it relates to the number of hours and certainly other things, you know, hybrid, work from home, work-life balance, flexibility. There's definitely been a lot more negotiation on all sorts of dimensions as it relates to this, and this certainly could be one of them. I
know from our perspective as a service industry, you know, we had technicians out in the field that could have easily worked 40 plus hours a week, but they just didn't want to.
Mhm.
They wanted to work about maybe 35 at the most. And so it
Yep.
was an interesting dynamic.
I'm just sharing an anecdote from the field, so don't read too much into this. And it's certain that, I don't have the data to back it up, but I was talking to a developer recently, and they were sharing with me that a lot of the skilled tradesfolk that they depend on, the electricians and plumbers and the rest, were working fewer and fewer hours. And these are folks that they have a longstanding relationship with, decades of experience working with them as partners, and they're dialing back their number of hours for reasons that are kind of hard to know. And it's possible that because that those trades are in such high demand that they can command a premium in terms of what they charge, and so once they hit their number, they go home, and that may translate into fewer hours worked per week. But because, again, they're in such high demand, these developers and others who are hiring these folks have to sort of accept that concession and do the best that they can with the fewer hours worked. So yeah, there are definitely these anecdotes that I hear when I'm out in the community that reinforce this notion that the labor negotiation between employers and employees is still very much an open question. Where this is going to land, what the new normal is going to be, what the new equilibrium of expectation is going to be. I think we've got a ways to go before a lot of that resets, and we can make sense of it.
And just I don't want to hijack this, but
please.
Just an observation over the years, and this really goes back to being in business for over 35 years, is that really what I saw was when employment dipped down around 6% or lower, that 6% was really the number where you had almost 100% employment of the people that A, wanted to work, and B, the people that were qualified to, there was 6% of the population that couldn't pass a criminal background check and drug screen and all that. And those were some of the things. So, you say unemployment's at 4%. Well, 4%, that's really almost 100% of true people that have the skill set to do jobs. So just an observation. It's, out in the real world.
And the unemployment rate is actually a little bit below that. It's, I think, closer to 3.6, 3.7. So, it's still a very, very tight labor market. I would distinguish between the labor force participation rate, which is all the folks who potentially could be working, and the unemployment rate, which is really a carve out for folks who are actively looking for work.
Right.
And there may be a slight difference between those two populations, but just want to add that to the mix as well. Any other questions on the labor force side before we spend a little bit of time on the inflation side? All right. So I think it's fair to say that when reflecting on the dual mandate and our expectations for a healthy and sustainable economy, that the labor market is about where we hope it would be, and it's, again, loosening a bit, but the unemployment rate is at closer or at all-time lows. So on that side of the ledger, doing okay. On the inflation side of the ledger, obviously we have a lot of work to do. The inflation has been and continues to be too high. You can see here from the chart that we were a bit below our longer run goal of 2% leading up to the pandemic. And then you see a pretty significant increase in both headline and core inflation. Core inflation strips out energy and food, just for clarification, but you can see that both spiked pretty rapidly between about 2021 and 2022, and since then has been coming down gradually. But we're still well above trend, so we have work to do on the inflation front. Just digging into this a bit more, we separate out goods-based inflation and services-based inflation. So I think this is particularly important given what we went through during the pandemic with supply chain disruptions. So as you can see here, so this is goods price inflation spiking very quickly as a result of those supply chain issues. I think we all remember that phase where, it didn't matter how much you were willing to pay for patio furniture, you weren't getting your patio furniture. So that I think this chart reflects that that imbalance of supply and demand as it relates to goods. But since those supply chain issues have been resolved, since we've moved further out from the outset of the pandemic, and as the rate environment has changed as well, you see goods price inflation falling pretty quickly back down to pre-pandemic levels. So that's good news. Less good news on the services side. We've made some progress, but as you can see, it remains too high. And there's a lot of explanations for this that I hear out in the field. I think we all heard the term revenge spending. A lot of folks who were pretty sick and tired of being locked up in their house went out and booked first class tickets to Europe, and went out to the steak the steakhouse, and really I think tried to make up for lost time. And I think part of that is reflected in this services-based inflation. The demand for labor in the service and hospitality industry continues to be high, and the supply of that labor continues to be out of balance with that demand. So all of that translates into higher services-based inflation, which again is beginning to come down, but remains significantly above pre-pandemic levels. So that's obviously where we'd like to see more movement as it relates to the inflation side of our dual mandate. Any questions about inflation before we turn to monetary policy? Okay. And again, please interrupt me at any time with questions, comments. Happy to answer anything that I can. Okay. So this is a chart from a document that we produce quarterly called the Summary of Economic Projections. And this is something that the Federal Open Market Committee, and I apologize for all the sort of wonky terminology here. That's sort of what we do at the Fed. So it's the Federal Open Market Committee, otherwise known as the FOMC, is the body that votes on interest rates. And it's comprised of the Board of Governors in Washington, D.C., and a rotating set of Federal Reserve regional bank presidents. So at any given time, some of those presidents are voting on interest rates and some of them are not. However, all of them contribute their forecasts for monetary policy going forward as part of the Summary of Economic Projections, otherwise known as the SEP. So that is what this chart is reflecting. Each one of these dots is a member of the FOMC. And it's their individual projection going forward of where they think interest rates are going to be at the end of each calendar year. So as you can see, 2023, we're getting close to the end of 2023, and there's quite a bit of consensus about roughly where we need to be at the end of the year. But that consensus starts to widen a bit by 2024, and you've got, as you can see, one member of the FOMC who believes that interest rates will remain above 6%, and others that believe that it will fall as low as 4 to 4.5%, and then a bunch clustered in the middle. And then that sort of diverging opinion sort of once again increases the further out you get, 2025, 2026, and then into the longer run, where you see folks come back to a little bit more grouping of opinion on that. I think if you sort of blur your eyes and look at this, you can see that there's clearly a trend line where rates over the course of the next few years are likely to come down based on these projections. But again, there's a significant difference between 5.5% and 2.5% if you look at the end of 2025. So it's really, really essential that we get this right, because there continues to be an enormous amount of uncertainty in the economy, and that is reflected here in these different opinions. And so obviously, we are a data-driven organization. As the data change, these projections will change. But this is as of a couple weeks ago, when we released our September SEP. This is where all the committee members sort of have predicted rates are going to go. So this is what's known as the dot plot. There are differing opinions about how useful this is as a monetary policy tool. I share it with you today, mostly just to make this larger point that there is quite a bit of uncertainty, and that opinions of the most informed folks on these issues differ significantly. Any questions about this before I do a quick wrap up and a plug for the business engagement that we do?
Dan Masterson here. I got two quick questions for you, Ian. The first question is, with these projections, is this taking into account any change in monetary policy, as in changing the fund rate, or does this take into account making those changes, or assuming nothing changed, it would result in this in the future? Does that make sense? Like,
oh, go ahead. I'm sorry.
The question is this before or after any monetary changes, or does this take into account estimated changes up or down in the fund rate?
These are estimated changes for the fund rate going forward, and they were compiled after our most recent FOMC meeting a week or two ago. So that decision about what to do with rates at that time, which was to keep rates steady, was already banked when I think these projections were made. So this is on a go-forward basis, and again, is purely the individual opinion of either the Reserve Bank president or the governor of the Board of Governors in terms of what they think the most likely outcome, assuming no unexpected shocks, will be as it relates to the Fed funds rate at the end of each of these calendar years. Does that answer your question?
Yeah, I think so. The second question, looking at this for business owners, large and small alike, it would seem that it's a pretty good consensus that that businesses should settle in for the next 2 years on additional inflation. Is that a reasonable assumption off of this metric?
I think I can't speak to the underlying economics. I do know that as part of the SEP, and I think reflected in these projections, the committee concluded that inflation has been a bit stickier than expected, and as a result, rates probably will have to be higher for longer. Now, all of that is subject to change if the underlying inflation data changes, of course. But given what they knew at the moment that they had to log these opinions, this is the path that they see is most likely going forward.
Right. And Ian, have you gotten any feedback from the business side on that businesses are thinking that's preparing for that for the upcoming years?
I can't speak to any data. I can only speak to the conversations that I've had out in the field, and I would say it's interesting. Inflation continues to be top of mind, absolutely, for a lot of business owners. But the rate environment increasingly is top of mind as cost of borrowing has gone up, and I think everybody understands that the higher rates are necessary to cool the economy to get inflation back to trend. So everybody understands that trade-off. But now they're kind of grappling with a bit of both, right? You've got higher than wanted inflation, and you also have higher than wanted rates. And I think a lot of businesses are going to be stretched by that, depending upon the type of business, of course. So it's certainly something that comes up in all of my conversations that I have with business folks, and I don't think that anybody believes that we're going to snap back to pre-COVID monetary policy or inflation levels, anytime soon. I don't think that's a prevailing view, and I think this monetary policy pathway here that you see reflects that it's a gradual return to hopefully a more sustainable trend.
Right, I appreciate that, Ian.
Any other questions about this? All right. So, in addition to just sort of sharing a little bit about our thinking, I wanted to share all that to kind of underscore this additional point, and make a pitch for why business engagement is so essential to us, given the uncertainty of the underlying data, the uncertainty of the underlying economy, and the I think very significant disagreement about where we're headed, which is I think based on a complex set of factors and data. We are incredibly reliant on the feedback we get from people who are experiencing the real economy in real time. We need to know, are people more worried about, the price of groceries when they go to the grocery store, or are they more worried about, the fact that they, can't necessarily buy the house that they could have bought a couple of years ago when mortgage rates were significantly lower. We also need to know, on the business side, are folks still, pretty bullish about the economy, potentially bearish about the economy? Are they in expansion mode? Are they in stand pat mode? Are they hiring? Are they hoarding employees? That's something that we've heard quite a bit about. I think a lot of businesses, per our earlier conversation, were pretty scarred by their inability to find workers at the height of the pandemic, and are maybe less anxious to let the employees that they have currently go, which is creating maybe some stickiness in the labor market. So all those things are really important data points for us, and the context that undergirds all of those sort of qualitative data points are really important complements to the quantitative data analysis that we do quite a bit of, but it won't necessarily give us the why, and it won't necessarily give us the where are we headed next. And that's why these conversations are so essential. And that's reflected in this quote from our president here in San Francisco, Mary Daly, who feels very strongly that the public engagement, business engagement, and banking engagement that we do is a crucial component of our monetary policy making. So I do this in a few ways. A lot of conversations like this, some over Zoom and some in person over donuts. I meet with business and community leaders pretty regularly. I host a number of CEO roundtables, either sort of sector specific. Let's say we needed to do a deep dive into chip manufacturing. I would pull together a handful of chip manufacturing CEOs and have a conversation about where we're at with chips and anything that we should be concerned about. But I also host more general conversations with CEOs where I ask them about the economy and how it's impacting their respective industry and business, and collect that information more in the aggregate. We maintain boards and councils. So there's a board of directors here in Portland that I help recruit for. It pulls from businesses in the Portland branch territory, which again is all of Oregon, some of the Columbia River Gorge, and the Panhandle of Idaho. And they meet regularly and actually vote on monetary policy. So it's not a binding vote, but we share sort of our recommendation for where we think interest rates should go. They give us their feedback and they vote on whether they think that's the appropriate path or not, based on their respective business or their perspective generally. And then we carry that forward to the head office board in San Francisco, which pulls from the entire San Francisco Fed district, which is quite sizable. And I didn't spend much time on this at the outset, and I should have. The San Francisco Fed is by far the largest territory of all the Feds in the system. It's the 9 Western states. I think it's roughly 20% of GDP is generated in our district. I think it's 20% of the population. It's incredibly diverse. And so, but we're just 1/12 of the system. So it's sort of an interesting artifact of the Federal Reserve Act and where economic activity was based in 1914 when the Federal Reserve was created. So we maintain boards at all of our branch locations: Portland, Seattle, Salt Lake City, and Los Angeles, as well as our head office board in San Francisco. And then finally, I host a number of listening sessions, just like this one, where I usually offer a few introductory remarks about the Fed and how we operate and why this is so essential, and then turn it back to the audience for some feedback. So I was hoping if you all are game, that we could do some of that now. And these are actually the questions that I am taking out into the community at the moment to ask the business and banking and community leaders that I meet with. And then just in terms of process, what I would do is sort of take careful notes of what folks share with me. And then in advance of our next FOMC meeting, I will share those notes with our head of public engagement, who combines the Portland notes with the other branch engagement notes. And then that gets sent to President Daley and our economists and becomes part of their briefing for that FOMC discussion. So that's kind of mechanically how it works. And would love to hear from you all now. If there are any of these questions that resonate, then would love to get your input. If there are risks or things that are not included in this list that are more top of mind than these, would love to hear that too. I mean, part of our job, my job, is to kind of stress test what we think we know by asking these questions, but also keep an open mind that there are things that we may not have noticed that are beginning to gain steam that may become important the next cycle, and getting a heads up about those things is equally important. So if there are things that are not on this list that are top of mind, would love to hear those as well, or answer any questions about the Fed as an institution that I can. And happy to stay on as long as folks have. So that's the end of my prepared presentation, and look forward to your questions and hope to have a good discussion here with the 20 minutes that we have left.
Well, I'll go. So a little bit of background on myself is so I spent 35 years in the cleaning industry, and here about a couple months ago, we actually just closed that business because of labor issues. Primarily, it was just too challenging to hire and retain employees, and so we just closed that business down. I'm also a commercial real estate broker, and on the commercial real estate side, and I also sit on the board of directors of McMinnville Economic Development Partnership. And to be honest with you, I don't hear a lot of concern from the people that I interact with in that circle over interest rates. I mean, they talk about it, but the reality of it is I don't see it impacting their ability to do business and grow nearly as drastically as the labor market. And here in Yamhill County, one of the biggest things we struggle with is available space. And where the problem lies is that we do have some available land in the industrial segment, not a lot in the commercial segment, but it comes down to return on investment. And while it may not be problematic for the business in terms of interest rates, it is for the developer. And when you compound the cost of construction, the available land, and interest rates, it is really difficult for a developer to get a return on investment, so they're not building speculative buildings. They're not building incubator space, those kind of things to support either startup or small business growth. And those are the two things that are the biggest challenge for us. It really comes down to available space for our businesses to expand into. I've got a list of, I've got a notebook page full of small businesses in the area that are looking for space of different kinds, and it's just not available. And that's really impacting, I think, our business community here.
Can I ask you, so obviously land use and zoning and the rest, those are local state issues that we obviously the Fed don't have direct control over, but I hear this a lot around the state, whether it relates to commercial development or frankly housing development. What's your read on why it is that land is not more readily available in your region? And just curious, what steps you think need to take place, not from the Fed standpoint, but maybe from other standpoint to free up some of that land for more development.
Well, I mean, certainly we all know that land use issues here in Oregon are super, super challenging. McMinnville's fortunate from an industrial standpoint that we have quite a bit of available land. The challenge is, and I'm not sure I understand the why of it, but we have a lot of people that own small parcels in the 5 to 10 acre that they've just been land banking for extended periods of time, even when interest rates were really low. Rather than build out commercial industrial type buildings, they've just been setting on the land. And I don't know if it's fear driven or what has kept them from doing that. On the commercial side, it's that was the industrial side. Really, on the commercial side, we just don't have a lot of opportunities here locally to expand our commercial footprint right now. McMinnville, Newburgh's similar in terms of we're kind of centrical around the core 99W corridor. We build everything out. We don't have any neighborhood commercial to speak of, which is really hindering. I mean, we've got some in the works, but not a lot of it. So those are some observations. And then the cost of redevelopment is really high. So if you're in the commercial zone and you have a building that needs to come down and a new building needs to be built in its place, it's almost impossible for that to pencil out with a return on investment for a building owner.
Well, can I make a somewhat adjacent point to this as it relates to monetary policy? There's a bit of a lag effect depending upon the sector when we're thinking about interest rates and it's, I think people think of, say, the mortgage market as indicative of kind of where we're at from an interest rate standpoint, because that tends to reset overnight, right? And so you see the impacts of higher interest rates or lower interest rates immediately in those products. But for the rest of the economy, it can take months, it could take a year, it could take longer for the effects of that monetary policy to work its way through. And I mentioned that in the context of the development cycle that you just highlighted, which is, you identify a piece of land, you're negotiating on ownership, you have to get the environmental review, you got to do all the things, the pre-development work. You got to get the contractors, you got to get the plans in place, you got to buy the materials, you got to build the thing. And that development period is so long that where the interest rate element hits you will depend on kind of where you are in that cycle and can probably be the difference between a project penciling or not penciling. So I just share that because it's not as precise of a tool as the mortgage product market would indicate that it is. because in the rest of the economy, interest rates just don't get absorbed as quickly. And so you're going to see different sectors, different pockets of the economy reacting differently to those changes over time. Any other questions or comments on these questions here?
Ian, I had a quick question. One of the
Yep.
things you said that the Fed does is monitor and adjust for how much currency in circulation. And the internet has rumors, but what percentage of the US money on hand is actually in print compared to what's there digitally?
There is an answer to that question. I'm going to hunt down that answer and share it with you. I don't know off the top of my head. I do know that there's more U.S. currency in circulation today than ever before. So the notion that cash is on its way out and being replaced with digital channels may be a bit premature. So it's substantial. But let me look that up. I can get you a specific answer to that question. It's a great question. And I'll loop back and Rhonda, maybe I can share that with you and you can share it with the rest of the group.
And that kind of leads into that other question, which I don't know if this is your world or a different division of government, but do you have anybody talking about the transfer to a digital currency? Like,
So,
or not the Fed's, like your job might be to dispense with what's done, that not necessarily be the decision makers, but what's your take in your role on what's been in the news about digital currency, which might be a reason why there's more US or more physical currency in circulation than ever before, right?
Digital currency is definitely not my role here. I will tell you that we are a congressionally mandated institution. Our mission and operations are set by Congress, and if they want us to pursue a digital currency at some point, that would have to be the wish of Congress. So I don't mean to punt on your question. It's just not something that we are empowered to pursue on our own. We would have to do it at the behest of Congress. So that's where I would look for progress on that front.
And so my question with that really has to do with the fact that your role in that situation would be more the worker bee in getting the job done from what you were told elsewhere in government. Is that correct?
Well, certainly me personally, I am always the worker bee in my role here, out in the community, gathering information. I'm not empowered to impact certainly anything related to our cash operations or any future digital currency conversation. So I would certainly collect that information, questions about that from, in particular, our banking partners and their thoughts on it, and take that back to folks who are thinking about these things. But personally, I'm not in a position to affect change on physical currency or any future digital currency version of that. I will say I'll take the opportunity, if you don't mind, to highlight that we recently launched our real payments platform, FedNow, which is not a digital currency, but it does enable banks to transfer money to one another instantaneously, which is currently, I think it launched in July. So more and more banks are signing up for the service. And we're excited about being able to offer that product to the banking community. And we'll have more to report out as people let us know how it's working for them. And the value that it's creating for their customers here in the next few months. And maybe we could do another one of these if you're interested in FedNow. I can come back and give you an update on how that's going and why it may or may not be the right choice for your bank or a bank that you are a customer of.
That's actually interesting to hear because I worked at a bank for 10 years and had some unique experiences on the backside when the economic crash. Got to be in a room with 30 Fed and state level people doing audits and stuff like that. So I learned a lot from that. A quick question on that FedNow, is that designed with the concept of replacing the current wire system, or what's the goal towards providing FedNow to banks?
I would say that it complements the existing tools that are out there. You're probably familiar with the product with the platform Zelle, which is a private market sort of similar product where participating banks can opt into Zelle and transfer money to one another instantaneously. FedNow is the Federal Reserve's alternative to that, and banks can evaluate the pros and cons of opting into one or the other. Really, the benefit of FedNow, again, as somebody who doesn't necessarily work with it day to day, but the benefit that I see is that instantaneous clearing of payments. And so if that is important to you as a customer or important to you as a bank, then FedNow certainly is something that is worth a look. Because I think customers in particular, as just speaking as one myself, I think we've grown accustomed to the notion that we can send money anywhere immediately, and the truth is that's not always the case. It may appear to be the case on the customer side, but isn't necessarily the case on the payment rail side. So FedNow would enable more of that activity, and so yeah, we're excited about it. It's still relatively new, obviously, but so far so good. And again, Rhonda, happy to come back and give an update in a few months when we sign up more banks and have a little bit more experience with the product and line of sight into people's expectations and how we can make it better.
Excellent. Sandy, while you're here, Sandy's a banker. Ian, I think I mentioned that to you earlier. Sandy, do you have any questions for Ian that he can help you with now? Or again, he offered that we could bring him back, but is anything coming to you that he could help with today?
No, I was intrigued by your dot plot. I've not seen that before.
Me too. I thought it was
cool.
So
I'm looking at where my rates are going to go here in the next 3 or 4 years. But no, I don't really have any questions. It is interesting when you talk about the FedNow. We're a small community bank, so for us, we're on board to be a receiver, but not quite ready to be a sender yet until we see how it plays out. I know that the institution to institution immediate credits back and forth have been a big target of fraud lately, and so we're just a little skeptical about that. Check fraud is on the rise like none other right now. I think it's because all the COVID money is gone, all those electronic deposits are gone that fraudsters were trying to break into before. So now we've gone back 20 years to check fraud. So, but I don't think that has much to do with what you're doing. But the FedNow thing is intriguing, but also from a risk standpoint, we want to make sure everybody's protected on our side.
Completely understand. And please, open invitation if I can answer any questions about FedNow going forward. I'm happy to put you in touch with that team. And obviously making sure that this is a safe product is top of mind for everybody here. So anything that we can do to do that and improve on that, we will. So please, consider me a resource on anything related to the Fed, but particularly FedNow if that's where the questions are coming from going forward. And sorry, before I lose the thread on the dot plot, just to underscore the point again, it's not predictive. This is, people's projections on a particular day and time of where they
Right.
think everything's going to be. Obviously, the world will change as it always does, and so our projections will change accordingly. But I think it does kind of give you a sense of what people's expectations are, again,
Right.
given current status quo conditions. But I will send Rhonda, if it's okay with you, I'll send the summary of economic projections that just got published to you, and maybe you can circulate with the group, and the dot plot is included in that. They also do projections related to GDP growth, unemployment, inflation, some other metrics. So not just the path of monetary policy. I didn't have time to get into that too much today, so I just pulled out the dot plot. But there's a lot of really interesting, useful information in that FCP that I'll send Rhonda to you immediately after this.
I'm going to call it 19 opinions. Just kidding. Oh my gosh. Okay. So, oh my gosh, Ian, thank you so much. We had great questions. I knew it would be an exciting topic, but was not really prepared for Mike's questions or Dan's. So very good. And I was not prepared to hear about the real payment FedNow platform. So that was definitely new for me. And that was good information. Another reminder that we will upload the video of this webinar after today's presentation so that you can share it out to other members of the chamber. Sandy, I think there was a couple more, maybe Lindsay and Tara, that wanted to join on today's call. So, okay, I'll be able to upload the video and they can view it at their convenience.
Perfect.
That helps. And yeah, again, great coverage on how the Federal Reserve works and the importance of local business engagement. That was amazing. Thank you, Ian.
Well, thank you, Rhonda, for hosting, and thank you all for attending. And honestly, please consider me a resource anytime. I work for you, so you know, if I can answer any questions as it relates to monetary policy or how the Fed functions, or things that I'm seeing out in the community, if that's useful to you and your business, please call me anytime. Shoot me a note, Rhonda. Hopefully, you can share my contact info, and always available as a resource. So please don't hesitate.
Great. Thank you, Ian. Thank you, Dan, for being here. Thank you, Sandy. Thank you, Holly. And Mike is gone. But again, put the webinar up and make sure I share it back out with you, Ian, once I have it uploaded as well. Sound good?
Good. Great to meet everybody. Thanks again.
Wonderful. Thank you again. Wonderful time. Thank you again.